Welcome everyone. Today we're going to talk about something quantitative. We usually talk about different financial analysis or investment strategy or investment trends. Today we're going to talk about something that could help you, especially those quantitative people, into different exercises. So we're going to talk about portfolio variance, covariance matrix, return, and standard deviation for 20 securities on Excel. And we're also going to show you how we can do some contribution to total and active risk. So the objectives basically how to compute total risk, so with volatility for more than 20 assets, how to convert correlations into covariance if you're asked to provide different total risk for a portfolio that has more than 20 assets and they can only give you correlations. Well, we can also convert them into covariance for the formula. And we're going to see how to compute active risk, so tracking error, and then how we can decompose contribution to total risk and contribution to active risk based on a benchmark. So basically, the formulas that we're going to have, the expected return formula, the total risk, which is our regular standard deviation consisting of n assets, and the correlation coefficient, which we're going to see that we can get the correlation and the covariance based on the standard deviation of the return of assets, on also the correlation coefficients between the assets. And look at this, the standard deviation of portfolio with three assets. We're going to do a 20. Look how the formula becomes. It becomes cumbersome. And a lot of people don't, usually in finance schools, in finance classes, they only teach you with two or maybe three assets. We're going to do with 20. So usually the weight of the asset times the standard deviation times, right, the two times the weights times the actual, correlation coefficient times the standard deviation times the standard deviation of the other asset. So if you have 20 assets, you have to do the correlation of each asset. So it will be a tremendous formula. So we're going to show you how we can simplify it. So stay tuned. And so we're going to use sum product and square root matrix multiplication and mult for total risk computation using covariances. Well, here we're going to finally present what we promised. So we're going to talk about how we're going to compute 20 assets in a portfolio, how to compute their risk and their total return and all the good stuff. So a lot of finance courses always just give you 2-3 assets because it's cumbersome to create that. So what are the inputs? We are given the 20 sub asset classes, so from US equity to cash to absolute return to commodities to high yield, etc. So then we also have the current weight. So the weights are basically the market value of asset class divided by the total market value of the portfolio. In this case, this is just an assumption. For example, 9.5. So basically means, say this is a 100 million portfolio, there will be 9.5 million allocated in US equity, and the benchmark has different weights. Then we have the volatility of those returns for the last 30 years. Here we have our 30-year annual return assumptions. So this is just capital market assumptions. 15.55 for US equity and for the different asset classes. And then we have the correlations. As you can see, the correlation matrix basically tells us, all right, how are the returns of these two correlated in the last 30 years based on different market assumptions. So in this case, 0.8770 is the correlation between the US equity and the global UX equity, right? 0.784 will be US equity with emerging market equity. As you can see here, this should be the same because this is just column 2. This is saying like, okay, global US equity to US equity. So it should be the same. So all of this should be the same to this column G. From here, number 3 should be the same to row 3 on the way to the end. So now this is the inputs. Let's start with our new stuff. First aspect, risk-free rate. The risk-free rate is the rate that you're going to get as a return for just investing in the bonds or in US government treasuries, like it's basically guaranteed rate. So if you don't want to take extra risk, you could get 3%. In this case, this is 3%. Fed fund rates are now at 5%. We're just assuming 3% for this example. Then the first step is to calculate the expected return. The formula is easy. It's the sum of the returns based on each weight, right? So how much is the US equity return plus the global US equity return based on its weight and return, and then you add it up. So in this case, it will be basically a sum product, right, of your return. So in this case, sum product, because we want to multiply, and sum of our weights, and then you go into your return assumptions, which we have here. We're going to use nominal in this case, just for the sake, and close the bracket. That should give us 7.25. Now, what's total risk is see how much, based on the volatilities and the correlations, this return can move, and tracking error is the difference between our benchmark and our current. So, because we have different weights, how much of that risk is being because of different changes in weights. Now, if we start with correlation matrix, you can compute that, but it's going to be hard. So here we're going to basically create from the correlation matrix into a covariance matrix, so we can use for our total risk. So our covariance matrix will be, the formula is basically your standard deviation of asset 1 times the standard deviation of asset 2 times to the power of 2. So in this case, if we start this one, it will be F2, because it's the correlation between US equity and global X US equity, times E2. In this case, E2 is our volatility, or standard deviation for that one, for US equity, times the same. Click that, and we should get 0.2. Hold on, this will be F2. Sorry, apologies. Because it should be F2. This is the correlation of the first one. Don't forget, so it's the correlation of the first one times the volatility of itself. And basically, your correlation of this asset times volatility of itself, global in US equity. And then for global X US equity, it will be F3. So in this case, F3 is the correlation of US equity to global X US equity times the volatility, right? E2, which is constant in this column, times the volatility or the standard deviation of global X US equity. And it's the same. So we keep going, row number 25, which will be the covariance of US equity to emerging market equity. In this case, again, F4. So it's a correlation here, and times the volatilities to that. So if you keep doing that, just the only constant should be E2, which is the volatility. You will get everything you need for US equity. Then you have to do the same. Well, this should be the same, right? Because this row should be the same as this. So it's just a matrix. This should be the same. And then this one will be just G3, right? Correlation to itself times your volatility to the power of 2. And then you keep going. So you do that. The formula is simple, but you have to populate it. There's formulas you can do this, but I just want to show it manually so you understand what we are doing. So now that we have our covariance matrix, let's go and calculate a total risk. Now the total risk is basically what we need to showcase everything else. Everything else meaning Sharpe ratio, tracking error, contribution to total risk, and etc. And this is where finance courses or every tutorial online lacks a lot, because they usually just stay at 2 because 2 is easy. So basically, the total risk is your standard deviation, is your covariance, the square root of your covariance. So we're going to start with square root. in sum product, right? Because we want to have the sum product. Now, if you wonder why the sum product is because we need the aspect of the weights to be computed, so we get all the good stuff. So let's start again. So my cursor went away, sir. Root times the sum product of the weights of the portfolio. So we can just grab them as an array. And now this is where we're going to use the mult, which basically returns the matrix product of two arrays, an array with the same number of rows as an array and columns as an array too. So basically what we're going to do is multiply, as we have in the formula, the covariances times the weights, and you will do that each time. So US equity will do with every single asset, global X equity with every single asset. So the formula will be huge, but if we use mult, then we can easily do that. So then mult will be, now we have to graph our covariance matrix, and then you do your weights, right? Because you need to multiply by your weights and your covariance matrix, and then you close this bad boy. So that should be your standard deviation. 10.49 is what we get. So this is the total risk of our portfolio. See how important is this covariance matrix. Now your tracking error is basically the difference between your weights and your difference between the weights in your benchmark and your portfolio, times of course the different covariances and stuff. So again, here before we compute the tracking error, we have to compute the difference between the different weights between the benchmark and the portfolio. So in this case, where is my cursor again? Here we go. In this case, I just computed the difference of how much underweighted or overweighted I am. This is asset number one, right? To the benchmark. So in this case, 9 minus 9.5, which is the same, it's 0. I just copy this to make it cleaner or easier to refer to later. So you can see, for example, benchmark in global X US equity is basically 1% higher. So 9.5 minus 10.5 is the difference. So this is the difference. It's important for our active risk and for our tracking error. So this is just the same as your total risk. So square root, because we need to find standard deviation. So covariance will be the square root of a covariance. So in this case would be, let's do sum product again. So the square root of the sum product of our weights, in this case, from here, the difference between the benchmark and the portfolio, or the portfolio and the benchmark. And then again, mult, we grab all of our covariance matrix, and array2 will be, again, your weights, not the weights of the portfolio, your active weight. And there we go. So this would be our tracking error, 0.18, and then our Sharpe ratio is simply another computation to see how much risk we are taking over the risk-free rate. So it would be our expected return minus our risk-free rate and divided by your tracking error, your total risk. Why is it? Oh, sorry. This is the opposite. B24. I think I need a parenthesis. Oh yeah, that's why. Apologies. Just dividing. Basic algebra. And then we divide this 25 and 24. There we go. So yeah, it's basically your expected return minus the risk-free rate, and then how much risk are you getting. So yeah, don't forget the parentheses. Apologies for that one. So yeah, now I'll have our Sharpe ratio. For benchmark, it's the same. It's basically the same formula, but instead of using for your expected return, instead of using the weights of the portfolio, you use the weights of your benchmark. So some product of the weights of the benchmark times your nominal return for the same asset. And the portfolio, the benchmark total risk is the same, but instead of using the weights of the portfolio, you're using the weights of the benchmarks, right? Square root of the sum product of your weights times your covariance matrix, which is here, times the weights of your benchmark. Now, contribution to total risk. So this 10.49, we want to decompose it to see how each of these sub asset classes is contributing to it, because that way we can assess, all right, we're being overexposed in certain asset class or underexposed or underweighted in another one. For that, we need the matrix multiplication. The matrix multiplication is basically again, it's just basically that factor that we have been using for computing total risk, but in this case, it will be your mmult, right, of your covariance matrix times the weights, 836 to, okay. These are the same weights as that are here. So it's just the same weights. So that's your matrix multiplication. So that's your factor. And then it will be basically to the, and your weight will be to the power of 2. But in this case, we just want to decompose it. So I want to show step by step. So we get the matrix multiplication factor. We get our product matrix times, which is the same, times your weight. So this will be basically your weight times your matrix multiplication factor. And then you you divide it by your total risk. So basically this divided by your total risk. See how important is your total risk, because this is just the percentage to that total risk. And you do the same for all of them. Multiplication, matrix multiplication using your specific weight. And then you multiply by your weight. And that should give you all of it. Multiplication based on the different correlation, and then we get it. So you divide by your total risk. As you can see, the sum of all of this is 10.49, which is equal to total risk. So we are good there. Now, contribution to total risk is basically the same. We need the matrix multiplication times our weights. But then instead of dividing by total risk, we're doing it by tracking error, because that's our active risk. So again, matrix multiplication this time is not about the weights of the portfolio, but it's about the difference in the weights. That's why it's important to compute our difference in weights for active risk. And then again, our product matrix is the same, your matrix multiplication factor times the weight, the difference in the weight. In this case, it will be 0 because this is 0. And then your contribution to total active risk will be this, basically multiply again by your weight, right? And then you get that. So the sum of this should be 0.18, which is the same as 0.18 in your tracking error. Now you can see, for example, here, same. You get all the factor, you just multiply by your weight. In this case, it will be this one, this weight, because it's the second asset. Then you multiply again by your weight. You divide then by your tracking error. So you can see here the formula. So the product matrix times your weight. So mmult times your weight divided by your tracking error. Hopefully this should be the same. Yeah, it is the same, 18.84. Next video, we're going to do a portfolio minimum return now that we have all of our metrics, but I just wanted to show you how we can compute in Excel a 20 asset total risk standard, total risk metric or standard deviation for a portfolio of 20 assets. So let us know what you think. Hopefully this is helpful for your exercises, and don't forget to subscribe and provide any feedback. Thank you. This is me in finance.